Hello and welcome to Money Matters TV. My name is Doug Hepburn of Hepburn Financial Advisors, and I'll be your host. I offer securities and investment advisory services through Cetera Advisors LLC, member FINRA, SIPC, a broker-dealer and registered investment advisor. Cetera is separately owned from any other entity. I'd like to bring in my guest host today, Ken Jordan of Princeton Mortgage. Ken, how are you?
Doug, I've never been better. How are you?
Fantastic. Every day is getting better, although it's probably most people probably aren't thinking that when looking at the markets these days. It's been a wild ride for the past few months.
It really has. Inflation is still on the minds of many business owners, and of course the big R word is on the mind of many general folks. The recession fears and how that's going to impact a lot of stuff. So yeah, it's we're at an interesting time.
I know, and it's although we seem to be seeing some uh, I dare say positive economic news. But I listened to several economists, and most recently, some of the things that we saw is that people are starting to feel like, or the economists are starting to feel like, inflation may have rolled over, that we may have hit a peak. Of course, inflation is a lagging indicator, so it's not until it goes down that we actually start to feel, that it's easing. But by that time, it's usually already priced in, and where things have slowed down significantly.
And I think we talked in our last conversation, the big question, because inflation is a lagging indicator, will the Federal Reserve appropriately, gauge their policy, or will they overshoot? Will they raise rates too high, over the next couple of months? And honestly, we will know in the second quarter of next year. That's really when we're going to know. But yeah, I mean, overall, it's just that you can talk to some people and think it's going to go one way, and others think it's going to go another.
Yeah, you're absolutely right. I mean, we gotta, even though we've seen a lot of pain behind us in the last 8-9 months, there may be more to come, depending on how things go, and of course whether or not the Fed can engineer a soft landing. I think that's a big concern for a lot of people. Right now, I know, if I'm not mistaken, twos and tens are inverted, meaning short-term bonds are paying more than longer-term bonds, which is generally an indication that we're headed for a recession, and that's because the Federal Reserve has a better control over short-term rates than they do long-term rates. But there are some good things to point out. Manufacturing continues to expand, although at a slower rate. New orders were down, but production actually expanded, which means that maybe some of these manufacturers can kind of catch up on the supply chain disruption that we saw from the pandemic. There's some data has suggested that inflation may have peaked, but I think that remains to be seen. And it fell for the sixth straight month in a row. But remember, we're comparing to year-over-year numbers, so at some point it's going to have to come down. The big thing I think we're seeing is that we saw a drop in home building, which is likely due to the higher interest rates. What are you seeing in terms of interest rates in your world?
I'll tell you what's really interesting about the interest rates in our world is the lack of a market on the higher coupons. When you talk to some of these capital markets folks, and I'll tell you what I think that means in a minute, is that the 6% coupon, 6.5% coupon, is still trading at a discount. You have to pay premium to get that coupon, and typically you can go higher in the coupon, and there's someone willing to pay more for that coupon because it's a higher return on their investment. We're seeing almost zero market on the 7% coupon, 6.5% coupon, which tells me one thing. The reason there's no market for those coupons is because the investors realize that at some point, those folks that are in those 6.5%, 7% books of business, they're going to refinance. There's going to be early payoffs. We call them EPOs. There's going
Sure.
to be EPOs on those books over the next 6 months because everyone expects rates to come down. So why pay a premium for a book of loans that you know is going to EPO on you? It doesn't make any sense. Now, some companies are taking a huge risk and are offering mortgages at a higher interest rate so they can do 0-point loans. But there's no guarantee that there's going to be a market for those loans when they bring them, when they finally close and they bring them to the secondary market. And that's a huge thing right now in our industry. People are asking themselves, do they go out there and offer these coupons knowing that 45, 60 days from now, there might not be anyone buying them for the reason that they're not going to pay a premium to hold on to something and not recoup their investment and not be able to accept, to be able to take that rate of return because they think that the EPOs are going to be massive. So I'm telling you, there is a lot of guessing going on right now in the secondary markets. It really is interesting.
It's funny that you mentioned that because I'm by no means an expert in the mortgage market, but I got to believe that some of these issuers and certainly the investors, but understand that there's going to be turnover and that people are going to refinance at a lower rate at some point. But there's got to be a payback period. I mean, how long do you hold the note? 3-5 years before you get your money back and you can accept a refinancing. Now, if it's going to happen that soon, within like 2 years before you actually get your
6 months.
6 months. Wow.
Well, you figure if what people are saying is true, and that the Federal Reserve is going to accomplish what it sets out to accomplish, they're going to increase the Federal, the Fed funds rate. They're going to push us into a recession potentially, or increase unemployment. That's that balance. They're saying, Fed will keep moving until unemployment gets below gets above the inflation rate. Well, if that happens, rates will drop. Rates always typically drop going into a recession. So if the Fed's successful, rates will come down. And if rates come down, all those 7% books, all those 7.5% books that they're trying to put out there, they're all going to EPO. And then they've only been able to collect for 6 months. Who wants that?
Yeah. So what you're telling us is they've slammed the brakes so hard that the mortgage investors don't want to hit the dashboard.
Basically,
because that's basically what's going to happen if the Fed overshoots. And
if you don't have top tier credit, high down payment, you're going to be looking at points even on a conventional loan. Wow.
Well, I guess that's what you get when you get used to low interest rates.
Mm-hmm.
But from your lips to God's ears, hopefully they'll return.
Yeah.
And we'll see some more sanity in the market. But, until then, we still have the Federal Reserve distorting things as they have for the past, 14 years. Well, that's very interesting stuff. I hadn't thought about that. We had a question from a viewer. There's actually Betty Thompson of Philadelphia. She asked, what's the difference between pre-approval and pre-qualification for a mortgage?
Well, Betty, that is a phenomenal question. And it starts with how much of your financial picture has been looked at and underwritten by the lender that you're working with. So a pre-approval, or a pre-qualification typically means that a lender, an originator, has asked you a number of questions, run your credit, looked at, okay, how much money did you say you made? How much money did you say you have in the bank? And they give a pre-qualification letter that says, I'm relatively sure we're going to be able to get this loan done. A pre-approval, or what some people call it a pre-commitment, is when they actually take your mortgage application without an address, without a property address. They structure 10% down, 5% down, maybe 10 potentially FHA. They collect your W-2s, your pay stubs, and your bank statements, and they put it in front of an underwriter. That way the underwriter can underwrite your job history. They can underwrite your income. They can look at your debt to income ratios, make sure they're in line. They can underwrite your assets and make sure that all of those assets are coming from a qualified source. And at the end of the day, they can issue a pre-approval or pre-commitment that says the only thing left to do theoretically on this borrower is find a property, bring in an appraisal and a title report, and you're done. What it does is it allows you to get a lot of the legwork done ahead of time. You can shop with confidence. And when you're able to tell your listing agent, the person who listed the house you'd like to buy, that your file's been pre-underwritten, it's going to give you a leg up on anyone who has a simple pre-approval. It's or pre-qualification. It is as close to a cash offer as you can get without having a cash offer.
Oh, that's fantastic. Great stuff. If you have a question and like to get it answered, here's how you can do that.
You can have your questions answered on Money Matters. Please go to our website, money-matterstv.com. On our homepage, click on the banner on the right that says, Send us your questions. While you're on our website, you can find information about our host and guests, as well as show notes and links about this show and past shows. Money Matters is also available as a podcast on iTunes and Stitcher, so you can listen to Money Matters while you're on the go. That website address, again, is money, MONEY, -matters, MATTERS, TV.com.
Well, shifting gears a little bit from the residential market and interest rates to the more commercial market, our guest today is Lauren Gilchrist, the Managing Director of Research for Longfellow Real Estate Partners, the largest privately held life sciences developer in the United States. Lauren directs Longfellow's research strategy, content creation, and thought leadership, in addition to providing macro and micro market research for underwriting and executing Longfellow's projects. Welcome to Money Matters TV, Lauren.
Thank you so much, Doug. It's good to see you both.
Great to see you too. You know, in being in Philadelphia, the first thing I thought about when we spoke was, gosh, we have so much life sciences real estate around Philadelphia, between all the pharmaceutical companies, the life sciences startups that are around here. But you actually told me that we're not as big a market as I thought. Is that correct?
Well, Doug, tracking the life sciences commercial real estate market is a really tricky endeavor. And because it's Longfellow's bread and butter, I do it very closely. So when we look across the country at the size of third-party owned and operated life sciences, the market in total is about 160 million feet, which in context is about the size of all of the office space in the Philadelphia region. So it's quite small and it's quite niche. Real estate's an alternative asset class, and in that way, life sciences is an alt asset class. So very small, very capitally intensive. And of that 160 million feet that we see around the country, only about 4.7 million feet exist in the Philadelphia region. Now that might sound small, and in fact it is quite small, and in context, the Boston market is about 30 million feet. The San Francisco market is about 20 million feet. And I'd put the San Diego market, which is, roughly the third largest market, at about 13 million feet. So we've seen a lot of momentum in Philadelphia as a result of the incredible science that is coming out of our universities, and also the commercial activity coming out of the pharma firms that are more typically in the suburban parts of the market. So it's a great time to be in life sciences in Philadelphia, but in many ways, we're just getting started.
Wow, that's fantastic to hear. Because we, again, pharmaceuticals have been so big around Philadelphia, and, we hear about a lot of these firms are shedding jobs, they're starting to shed real estate, but to hear that, we're actually growing in terms of the amount of life sciences activity in Philadelphia is really good,
Yeah. And, Doug, it's really interesting to think about the future of the science portion of the industry when we think about the real estate conversation as well, because although, we have definitely seen, some elements of the life sciences industry be impacted by the macro conditions that you and Ken were previously talking about, the large pharmaceutical firms are increasingly growing as a function of M&A activity, as opposed to, internal homegrown science. So a lot of the market activity that we're seeing today across the country, and certainly in Philadelphia, is a result of those types of merger and acquisition activities. So to be sure, some of the biggest investors besides the United States government, besides the venture capital community, are in fact those large pharmaceutical firms as they grow through merger and acquisition by acquiring smart and revolutionary science.
Lauren, I have a question. What is the strategic advantage for these life science companies to invest in real estate in more urban areas, as opposed to, like you had mentioned, a lot of the pharmaceutical companies with their, more their suburban real estate? What are some of the strategic advantages of being in a city like Philadelphia?
Great question, Ken. So essentially, the long-term history over the 20th century for life sciences and pharmaceuticals was to invest in research parks outside of core cities where you could essentially protect the IP, protect the science, keep the talent from leaving, right? And that model, which really prevailed during suburbanization in the United States history, so call it the 40s through, the 60s, really resulted in these isolated corporate campuses, drive in, drive out, security gate, no place to eat, etc. And much like the rest of technological innovation, in today's 21st century economy, the spontaneous collision and collaboration of the brightest minds is what's producing the future of the sector. So what we've seen in the last, call it 10 years or so, is a proliferation of scientific activity in what I would call innovation districts. So if we're thinking about the Philadelphia context very specifically, University City is one of those true innovation districts. It has all of the ingredients. It's got universities, it's got medical institutions, it's got office, occupiers that support the ecosystem, like the kinds of patent attorneys that you would want to see supporting life sciences, like the kinds of accountants that are familiar with the complexities of, doing accounting in this kind of startup environment. And then you have all of these ingredients brought together in a dense urban node where you could be walking down the street and talking to your attorney, and then the next minute you're talking to a Nobel Prize winner and exchanging ideas, for the next iteration of technology to cure cancer. And in many ways, we've seen this actually play out in the evidence. I don't know if anybody recalls this, thing called COVID-19 that we all just went through, or how we, saved the world with mRNA vaccines. But that technology was originally developed at the University of Pennsylvania as a result of one of the key
Right.
scientific discoverers essentially finding herself at a photocopier with one of the most prominent scientists in the world developing mRNA technology. So that is a long way of saying, these innovation districts are where we are starting to see true catalyzation of revolutionary technologies. And that's why we're seeing the real estate respond.
That's really interesting, and I know Philadelphia has been known to have a much more affordable environment. There are many companies that often will relocate to Philadelphia as opposed to going to DC or New York because the cost of living is so much more affordable. So is that also driving some of these metrics?
Doug, I think that really what we're seeing in Philadelphia right now is a function of our extraordinarily strong niche in cell and
Right.
gene therapy, and a little bit less right now about the cost of living. I do believe that that will be a future driver as we see cost increases in some of the most prominent life sciences nodes like Boston, San Francisco. It's no surprise,
Sure.
that these are also some of the most expensive housing markets in the country. But the
Right.
reality is, in terms of real estate and the real estate for the commercial activity, it's really a very small line item on a company's balance sheet, all told. The order of magnitude of the cost of the real estate versus the cost of the talent is about a 10x differential. So if we think about what's really driving the top line in terms of, or I should say, the top line development, of the revenue and the science, it's truly that access to talent, and it's truly, the best and brightest minds. And really, that's much more of the equation. Philadelphia right now, from a commercial real estate perspective for true lab real estate, the market sits somewhere between $60 and $65 a foot, depending upon the metric and the length of term and the, tenant improvement dollars and so forth, which, is still more expensive than a market like North Carolina, for example. But the companies that are here have very strategic reasons for being located in this dense cluster of talent.
It's that pollination of ideas and talent and, research and development that's all exist in such a small area. I think that's a real benefit to, speaks to one of the best things about Philadelphia.
It's a real economic cluster success story, Ken, in the sense that, we have grown our niche in cell and because we had some really successful early pioneers in cell and gene therapy. Spark Therapeutics, another really great example of this, right? Essentially, had one of the first licensed gene therapies in the market to, cure a form of childhood blindness that then went on to have applications much more broad for hemophilia, right? A worldwide disease that affects millions of people. So very profitable, right, to develop therapies for that particular niche. And then the company goes on and gets acquired by Roche for about $4.5 billion. So that cluster and then the capitalization and the recycling of that capital really goes to serve the overall ecosystem in terms of the future of the scientific development, as we prove that this is a market where you can successfully raise money and then successfully exit.
Wow, that's interesting stuff. So what markets are really growing the fastest right now?
Great question. So in a lot of ways, I hate to say this because I'm a Philadelphia promoter, but Philadelphia is a secondary market in terms of life sciences. So the 4 core clusters, as I would define them, would be Boston, San Francisco, San Diego, and North Carolina. And those are predominantly the markets where our assets exist today. And that's for a reason. A market like Philadelphia is really on the radar of a number of different high profile operators. And you see that in terms of the investment dollars that are flowing into the market today in the form of new projects from, groups like Wexford Science and Technology, which is a subsidiary of Ventas, as well as Breakthrough Properties, which is a subsidiary of Tishman Speyer. So, we're definitely a part of that growing market story. Other growing markets, we've seen a lot of momentum in Chicago, Fulton Labs in Chicago, a big, transformative project, interest in the Maryland market. So, the NIH, for example, National Institutes of Health, along with all kinds of other government resources, that are going into those investments for defense purposes, but also basic scientific research. They're all located in and around Washington, D.C., but there's not been a very large third-party owned and operated real estate market really until recently. So we're seeing a lot of momentum and interest in assets there. We have a new project in New York that's been written about in the paper that is looking to, capitalize on the dense cluster of talent by virtue of the fact that New York is the largest city in the country and therefore has one of the largest scientific talent pools in the country. In order to create, those spaces for companies to step out of those medical and university institutional spaces and into third-party owned and operated graduation spaces. Lots of momentum, in the Denver Boulder area by virtue of the fact that they have seen a large cluster of technology talent and therefore also life sciences talent. Same thing in the Seattle market as well, and 1 or 2 of the Texas markets. So really, there's a lot of capital flowing into the space because from an asset class perspective, it's really one of the asset classes that has truly withstood the impacts of COVID. I mean, we see what's happening with office right now. We've got vacancy rates and sublease rates ballooning, but life science, you can't really work from home on a Bunsen burner. So we've seen continuous sustained occupancy and therefore investor interest.
So what are so one of the questions we had discussed earlier is what are some of the, I guess, the driving factors, what's driving new operators and capital in, to the life sciences space? And you had just touched on that a little bit, but I was hoping you could expand on it.
Right. So first and foremost, life sciences became the darling asset class of the pandemic because of the worldwide fascination with how do we fix COVID? Right. And in many ways, that kind of top of the fold headline spurred a lot of institutional capital to say, well, there must be a real estate need, if we're going to be investing in this race to cure, one of the most challenging diseases, that humanity has ever faced in modern history. So that fascination And then therefore the recognition, that you couldn't work from home and in a lab, right, is really a big part of what has driven, capital allocations to the space. So we've seen a lot of groups increase those allocations. In the United Kingdom, for example, I've heard, in sort of the rumor mill of commercial real estate, that there's more than $15 billion of capital chasing what is today a 7 million square foot market, which will precipitate the development of a significant volume of net new construction. And to be sure, that's a dynamic that we've seen in the United States as well, where in a market like San Francisco, which today has about 20 million square feet of third-party owned and operated lab real estate, is presently seeing a construction pipeline that totals more than 50 million square feet.
Wow.
So we're talking about, a 2.5x increase in the size of the market. And when we're looking at today's environment, in terms of debt costs, right, in terms of allocations and so forth, to be sure, I don't believe that all of those projects will be built. But there is 10 million square feet underway in a 20 million square foot market. So how much of that delta of 40 million square feet gets pulled off of the pipeline? Hard to say at this moment, but it's going to be very interesting because the construction pipeline in Boston, similarly large. Construction pipeline in Philly, similarly large. And, the question will be, does the demand in the short term meet that construction pipeline? In the long term, I think the answer is yes.
Well, that is a great segue and an explanation, I guess, as to why, healthcare real estate and life sciences real estate is an alternative asset class. Because, if you look at healthcare investments from the equity side, they've actually done very, very well just from demographic changes and shifts in our population. And, the extension of mortality to over 15, 20 years over the last 60 years. And now, having to take care of people who are older and starting to break down. The fact that these alternative, life sciences companies are buying so much and building so much, that just has a great trajectory.
That's right, Doug. And the asset classes are quite different between medical office buildings and R&D lab facilities. And in fact, an even more niche aspect of sort of the life sciences space would be the GMP space or the biomanufacturing space, which is, another sort of niche within a niche within a niche, right? But when you look at, the MOB space and sort of the general spatial relationship to life sciences, you do sort of start to, I think, understand the trajectory. So in Philadelphia, for example, we benefit from having a large patient population with the University of Pennsylvania's health system, which provides a prime group of candidates for clinical trials for a lot of these startup life sciences companies to quickly gain access to patient populations. And, when you think about, the future of the market, I do think that linkage between the MOB space, the life sciences R&D space, and the biomanufacturing space is going to be critically important. And, just to think about your general demographic question of all of the people that are aging into, their later years, for example, there's a prominent company out on the West Coast in the San Francisco area called Altos Therapeutics, just raised $3 billion, essentially to stop the process of aging. Right. So we think about what the opportunity is there. They're capitalized by some of the most famous businessmen and women in the world right now. You can go do a little research on Altos. But, there are lots of people trying to figure out how to slow that process even more to improve health outcomes.
Well, this has been a fascinating,
right?
Yeah, it's been a fascinating discussion. We're going to have you on again. But, what's really interesting is our next guest is going to be Tiffany Wilson, the CEO of the University Science Center, and who I'm sure is also in the space and seeing a lot of the same capital flows and interest in Philadelphia. So we welcome you back. Thanks for watching today and watching Money Matters TV, where your money matters.